There's often a saying in investing, buy the rumor, sell the news. And that was on full display this week as markets rallied into inflation data and then sold off into the end of the week. So this brings us to an important question. What happens next week as we enter a critical FOMC week? And while the Fed is expected to leave Fed funds as they are, we get the much anticipated interest rate projections, and these tend to move markets. So should we expect volatility next week? And if so, how should we prepare? Today, we discuss that and sentiment, where we are in the economic cycle, and sector valuation. There are some expensive sectors and there's definitely value to be found. So buckle up, we have a lot to talk about. Let's roll the tape. Welcome everybody to a special weekend edition of the show. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and you know what to do with the comments, guys. It really helps me out with the algorithm. Let's get into it. Now, this is the weekly heat map for the S&P 500. We could see very mixed across the board, but this part of technology right here took it on the chin. That actually led downside flows in tech, simply because this is actually a very big part of technology. We also saw infrastructure tech didn't do so well, but some of the bigger guys did. Nvidia eked out a gain, same too with Microsoft, Apple, Google, not so much Meta. Amazon was down, Tesla in the dumps, down 35% this year. Some of the best performing sectors were financials and energy, and then healthcare was mixed. All in all, if you are in cyclicals, less technology, I think you did really well this week. Now, actually looking at sector performance, now there's actually not much to go on. Energy is always going to outperform when you have hot inflation prints. Same with materials and gold as well. And they were the best performing sectors for the week. We also had some defensives and financials there up the top, outperforming the SPY. That's really the benchmark you want to use. And then the worst performing sectors was like metals mining, regional banks, and semiconductors. There was no real leader this week. It wasn't a cyclical or defensive led rally. It was just a very mixed bag of trade. And that's what you get sometimes. Now, let's actually look at year-to-date performance for indices, sectors, and different stocks. Now, we can see that this is the bench line right here. This is the S&P 500 up 8% year-to-date. And for 2.5 months worth of trade, you take those gains any day of the week. Very interesting to see the Nasdaq 100 only up 7%, the S&P 500 outperforming. The best performing asset is Bitcoin right here. Then crude, comm services, info tech. The worst performing is US Treasuries, real estate, the euro, and investment grade credit. All in all, the S&P 500 continues to be a great investment. While there are some other sectors that have outperformed the S&P 500, look at everything it's outperforming. And this is really why the S&P 500 is just a great long-term investment for those of you that don't want to think about their investments and just invest away. Now guys, this is the S&P 600. So we covered the S&P 500 from the monthly chart, weekly, and daily yesterday. Today we'll be covering S&P 600 and then mid caps tomorrow. Now, something very cool to note, the S&P 600 was up nearly 0.5% at the same time that the broader market was down and yields were actually up, particularly the 10-year and the 20-year ever so slightly. So a bit of divergence there. That's really good to note. Looking at this as a whole, we are in the context of this massive uptrend. There has been quite a lot of volatility on the way, but actually just zooming in to the section where we are right now, you can see that we are sort of in this correction happening right here that's been going on for about 12 to 15 months. This is a correction in time. Now let's actually chart some of these levels just so that we have some stuff to work with. You can see that right here is a very critical level, as well as this double bottom level right here. The reason that level is so important is because we used it as support right here. It was a previous all-time high resistance level before going on a vertical rally here in 2021-22. Now we're also going to mark this section right here because this is a double bottom that we have formed in the Russell 2000, and this makes up this massive, and this rectangle here makes up a massive time correction we're seeing in the S&P 600. Now zooming into the monthly candle, we're not going to pay too much attention on it simply because the month isn't closed, but it currently is red with wicks on both sides, and we are just above the 1271 level. But let's actually hop on the weekly chart. Now, just to give you guys context, this is the massive correction zone. Now, looking at the current candle structure and location, a red body candle with a large bottom wick where we bounced off the 1271 area, which is this very, very key zone that we used as resistance multiple times right here, here, and here. Resistance then turned into support, as you can see, and we are now trying to break out from this massive correction in time that we've been in, this massive balance zone we've been in since, you could say, April 2022, possibly Jan 2022. So the better part of 15, 18 months. Now, we did attempt a breakout right here in early March 2024. However, that breakout did fail. We put in a 52-week high that is constructive, and we actually did go ahead and form a higher low relative to this low right here. So all in all, this is constructive because we put in a low, a high, higher low. Now, we haven't put in a higher high just yet, but we did put in this low right here, and this is looking constructive to stay on the uptrend. However, there's a couple of things that need to be noted. The very first thing is that this level right here needs to absolutely hold. We call it 1247. If we get a daily close, potentially a weekly close below this level, I think we're going to see some vicious sell side to possibly as low as 1098. So this is a key level for the bulls to hold, and you can see they did hold the 1271 area on Friday. Now there's two possible ways this plays this week. We stay above the 127 area, sort of like grind here and then move up, or we just move up. The risk is if we do grind, with the way earnings have come in for small caps, we could actually just break lower to 1247, and then it's like super big risks in the market because we can go ahead, break these levels, and then start a massive sell and completely void this uptrend that we've built for the last couple of months since the October lows here in 2023. Now the bull case is stay above 127, react, right? Or just rally from where we are right now. The bear case, if you're a bear, you really want to see 1271 broken and 1247 broken in this window of weakness. So you have 2 weeks here in March to get below this 1247 level, and you're not too far away. From where we are currently to there, it's 3.12%. You could easily do that in one single day, especially if some data comes in hot and we don't get the rate cut expectations we want. We do know that small caps are highly dependent on rates. However, looking at the daily chart, and there's no new levels to add, it's actually the exact same levels. This 127 level where we are right now, bulls just need to rally or potentially use as support and then rally, and bulls really don't want to get below 1247 because then they're going to be forced to work. They may as well just stay above here and rally. Otherwise, they're really going to have to put in the work at 1247. If it does break below that, that's when I'll update you guys each and every single day. But for now, it's not something we need to worry about, and we could just look at higher price action. Why? Because we are in the context of a uptrend, as you can see with this low, high, and then higher low forming, and looking to go ahead and make a higher high right there. And secondly, you zoom out on the monthly, we are in the context of this massive uptrend, and you never want to fight the trend. So all in all, I remain bullish on small caps. The thing is, it's just taken a lot longer than expected to go ahead and break out of this massive zone that we've been in for the better part of 12 to 15 months. But yeah, there you have it. Bullish above 1271, bearish below 1247 for next week. Now, looking at S&P 600 mid caps, we're just going to look at mid caps really quickly. It's very similar to small caps. We're in the context of this massive uptrend where we made a high in 2021. This is a monthly chart, by the way. We pulled back from that high, formed this uptrend balance area, which is a little bit different to small caps, which were kind of more a rectangle. This is sort of more a rising wedge type of balance area. And then we actually went ahead, made a monthly closing high, and actually made a wick all-time high here in March. Now, zooming in to the weekly chart, because we're not really done the monthly chart, you can see a couple of key differences here between the S&P 600 and the S&P 400. The first is actually this right here. This resistance zone, we didn't just use as support. We used that support at the bottom of the range, broke out, and we actually have hit all-time highs in S&P 600 mid-caps. At the same time, this trend line right here is actually trending up, whereas in S&P 600, we're sort of like a flat trend line, and this does support the fact that, you know, S&P 600 mid-caps are far stronger than small caps. Now, looking at the weekly, looking at the latest candle, I'm just going to delete these lines right here because all we need is this uptrend line. Since we did use as resistance, this is the main one. Now, on this weekly chart, guys, we could actually pull back to as far as this 2705 level and still be in a technical uptrend. As long as we hold this key levels right here, we would still be very bullish, especially these wick lows. And if we actually go ahead and measure how far we are from where we pretty much closed to where we are right now, we're about 7.55% away. And on a peak to trough basis, this? 9.68%. So it's a 10% pullback if we do go there, just less than 10%, but we would still be constructively bullish if we do, as long as we find bullish support here around the 2705, maybe 2700, call it a psychological level. But let's look at the latest weekly candle. As you can see, a red bodied candle, just like most of the other indices, a wick on top, a wick on bottom, but a clear win to the bears, simply because we actually couldn't go make a new high, especially not a wick high compared to last week. And we actually did form a slightly lower low, but inconsequential in my personal opinion, especially on the weekly chart, considering the context of this uptrend where we made a high right here, we then made a low, we then made a higher high, we then made a higher low, and then we went and hit an all-time high in mid caps. That is bullish. As you can see, this is bullish structure right here, especially coming out of this massive time correction we had. Now looking at the daily chart and looking a little bit weaker on the daily chart, you can see that some of the key levels right here have been breached. This low right here, as well as this equal low, has been breached, but it hasn't been a close below. It was a wick below this line right here. However, on a daily chart, there are a couple of levels that I do want to look at to find critical support. Otherwise, the pullback can extend into next week. And that level is right here. It's the top of this range right here. And we do know that resistance eventually becomes support. Support becomes resistance. And this is the level on the daily chart that we could look to pull back. So next week, we can pull back to here. If we find support, then we actually will rally. If we do actually break below this level, then we probably will go to the 2700 area. Maybe towards the end of the week, start of the week after. But 28.14, let's call it 28.15, 28.15 is the daily support level. So we could pull back all the way to here, and considering the strength on the daily chart, pull back to here, find bullish demand, and then make our way up. That would be completely normal, and we would still be in the bullish trend. We do break below here, we would still be in the context of a weekly trend, and then we can find support here. If we do break below the 2705 area, that's where things look grim, but I will update you when we get there, because like I said, we're 6 to 7% away, and we can take it day by day as it is right now. All in all, for the bears, you want to push to the 2814, but the bulls have a lot of room to work with all the way to this level right here. So, bears can push, and then they're going to have to push some more, whereas bulls can kind of just wait for a pullback and then actually look for dip buying opportunities. And that's why I'm constructively bullish on S&P 400 mid caps right here, especially if we get to 2814. You can actually just buy the dip right here. And even if you do buy the dip, you can then re-add a 2705. So the bulls can take it easy next week in terms of this. You can actually just wait for the pullback. The bears have a lot of work if they want to make that pullback into a sustained rally to the downside. Triple witching OPEX is behind us, and these are the stats we can expect. So March post OPEX weekly performance when the trailing month, so 21 trading days, is either positive or negative. So in 2024, we've returned 2.33% in the last 21 trading days. What can we expect? Normally a negative 0.89% return, 5 wins, 18 losses. So the stats are on the side of the bears. You can actually see that it was far better to be negative leading up into this week, because a negative trailing 21 days normally returns 1.09%. However, it's half and half, 9 wins, 8 losses, and still very, very negative when you look at it on an absolute basis. So all in all, what we do actually see is that post this triple witching, post the monthly OPEX week, is pretty negative on the stats, all things considered. Now, looking at sentiment, this is the sentiment indicator by Goldman Sachs. This is BOFA's bull bear indicator. Now, this is more of a midterm indicator. What's the sentiment like in the medium term? This is more longer term, and we could see that positioning is very stretched in the midterm here in Goldman Sachs indicator, hitting to some of the highest levels we've seen since early 2023 right here. At the same time, BOFA's bull bear indicator has actually pulled back. It was at about the 7 level, 7.1 I believe. It's pulled back quite significantly, and all this is telling us is that in the midterm we could experience some volatility. Maybe it's time to take some money off the board and wait for a little bit of a pullback, and when that does come, buy that dip. But on the longer term basis, this indicator is telling us that things are not yet frothy enough, and there probably is still upside in the longer term. And I think that's what these two indicators are telling us. So all in all, it's either hold, trim, and buy the pullback. Another great long-term indicator that's really ticking up is the global wave. Now, it's signal positive for equities and cyclical assets, and all this indicator measures is industrial and consumer confidence, capacity utilization, unemployment, producer prices, credit spreads, and then the earnings revision ratio. And we could see that it actually trothed out right here this week. And when that normally does happen, we can actually see the economy do much better. Now, we have had one false signal right here in early 2020, but I think this had to do with the COVID situation. Excluding that, this is normally a very reliable indicator for improving global macros. Now, looking at another global macro indicator, this is the regime indicator here, and it actually advanced in February. Now, this is everything that's included in this indicator right here. You guys can go ahead and read this. But according to BOFA's regime indicator, it improved for the second month in February, confirming the recovery phase, as you can see right here. Now, phase 1 recovery, according to BOFA, favors value, small size, and high risk. And we're coming out of phase 4, the downturn, which is high quality, low risk, large size. Just think about last year. What were the winners last year? It was high quality, it was low risk, it was large size. And now we're back into this phase 1 recovery, as you can see, coming off the inflation surge we had in 21-22. Now let's switch gears and talk about US macro. Now, something we're seeing is tax refunds. So week 5, week 6 is the first and second weeks here in March. We're actually seeing 2024 tax refunds tracking at about the average. And this is why we had a huge amount of inflows into equity. 56 billion worth of inflows into equity, the highest since March 2022. And I think it has to do with the fact that people are liking where the stock market is going. They're seeing all-time highs and they want to get in, and they're putting their tax refunds towards equities. Now let's talk data. It's a big week of data. The main focus is going to be here on the FOMC as well as interest rate projections. We get the dot plot. We also have some other minor prints here: housing starts, building permits, as well as PMIs and initial jobless claims. Wednesday, the March 20th, is going to be everything about the FOMC and monetary policy. So this is going to cause volatility in the market, especially if there's some changes that the market doesn't expect. Looking at earnings, not a big week of earnings, highly unlikely to cause major volatility except in certain sectors. We got stuff like StoneCo, DLoco. These are like South American e-commerce brands. Look, we also have Micron as well as Nike, Lululemon, and FedEx. So big notable names, but nothing that's really going to move the market. Next week, there's going to be a big focus on the macro as well as monetary policy and where that's going for the rest of 2024. Now, keeping up with the theme of earnings, we got some data here, guys. Now, forward earnings expectations are still marching higher, as you can see right here, sitting at $249 earnings per share on the 12th of March 2024. And according to Carlson Research, returns are mostly driven by earnings over the long term. Since 2020, S&P 500 total return drivers, 47% of it has actually been because of earnings growth, 15% has been because of multiple growth. Dividends accounted for 9% for a total return of 71% since 2020, and that's 20, 21, 22, 23, almost 4.5 years or 4.25 years of trade, 71% return in the S&P 500. And here's the crazy thing: January 2nd, when the market opened, had you bought, held through the COVID situation, you would be up 71% on your investment. Kind of crazy when you think about that. Now, with regards to this earnings data right here, where do we sit with valuation? Looking at the S&P 500, this is a bunch of relative valuation metrics on a PEG basis, something I love looking at. The S&P 500 sits at 1.5 times and a 20.8 PE multiple next 12 months. The cheapest sector here in the S&P 500 is actually energy at 12.6. We don't have a PEG because it's really high, but it's sitting at a 7.5% free cash flow yield. Compare that to a 10-year treasury at 4.2 or the S&P 500 at 3.4. Present value of cash flows for energy is actually really good. The most expensive sector here is information technology, tech, as well as discretionary, but on a price to earnings growth ratio, it's actually one of the cheapest sectors. However, I still think best value for money that you can get right now is comm services. You get a 5.1% free cash flow yield, 0.9 PEG, anything less than 1 is what you want, and an 18.5 next 12-month PE. And I've actually been buying a ton of comm services simply because GigaCloud Technology is a comm service name, as well as Google. Those are the two stocks I've been buying a lot of lately, and it's simply because the free cash flow is great, price to earnings is great, and the next 12-month PE is great. On a relative value basis, it's the cheapest, it's offering growth at a reasonable price as well. But things are looking a bit frothy in certain sectors. Look at the free cash flow yield here of information technology, as well as the growth rates here of staples and real estate, not looking too good. But all in all, S&P 500 looking a little pricey on certain metrics. At the end of the day, you are investing in such high quality companies in the S&P 500 that you just don't get anywhere else in the world. And that's why the S&P 500 trades at such a premium. Look at Apple, Microsoft, Google, Meta, and all of the other names that you get down the line in the S&P 500. It's extremely high quality businesses, and probably the best 500 businesses in the world. With regards to all of this, let's actually talk rate cuts, because this is one of the reasons why valuations are getting bumped up. It has to do with the market pricing of rate cuts. Now, we do get the Fed interest rate projections next week, but we can see here that as the market has pared back rate cut expectation, the S&P 500 has simply kept on rallying, simply because it's looking past the amount of cuts that's going to happen and towards the fact that cuts are going to happen. We were getting 170 basis points worth of cuts. This was priced in as early as the 10th of January. We're now looking at just 75 basis points worth of cuts, and that's just 3 rate cuts here for 2024, about 25 basis points per cut. The first cut looking like June, maybe July. But all in all, if these Fed rate cut projections keep getting pushed back, I think after December, the market is going to really start to freak out and say, hey, where's this going? Knowing that rate cuts are coming, how are investors positioning? We're seeing more and more investors and traders take up long positions in bonds, according to JP Morgan. Longs rise, they're out of neutral, shorts unchanged, and the lowest since 2012 after the vicious bond bear market we've had. Investors and traders are not really in shorts, they more want to be long bonds. We can see that a pretty huge percentage of investors are net long. It has come down from its peak, but all in all, we are seeing longs rise, especially long in aggregate, and shorts getting liquidated as well. So all in all, investors and traders are positioning long for rate cuts and to gain appreciation, as well as lock in some of those very attractive yields, anywhere 4 and 5% plus. Let's switch gears, guys. We're actually going to talk about Alphabet and the public portfolio. Something I don't really do. We talk a lot about the macro, we talk a lot about the technical, but we rarely ever talk about the fundamental outside of S&P 500 earnings. So we're going to look at some minor fundamentals here of Google. It's not going to be a deep dive, but it's going to be a pretty good reason as to why I bought it for the public portfolio. Now, full disclosure, I did own a huge stake in Google. On the 13th of February, I actually sold that stake, and we're going to get into why I did that. Now, this is my position in the public portfolio. I own 3.3 shares of the Class A. Average cost was 1.38. This portfolio started last week, by the way, guys. And for those of you that don't know what it is, all of the YouTube money that I make, I put into this portfolio right here. I only have 2 positions right now. It's Google Class A, as well as a company called GCT. And if you want the rundown of GCT, go check out yesterday's video. But right now we're up 2.11% in total, $9 gain on $446 in Google. We own 3 shares. Now, Google is a free cash flow machine. Since 2015, they have 6x'd their free cash flow, and that is absolutely incredible. And you can see that price has followed free cash flow. Now, the reason why I actually got out of Google has to do with their latest quarterly figures. Now, the reason why I personally got out of Google, it did actually release all right results. Revenue was up 13% year over year. Its operating margin actually dipped to 27%, but ultimately the biggest reason had to actually do with their free cash flow. Their free cash flow hit just under 8 billion. It was 7.9 billion in Q4 2023. It was actually much lower than the year before at 16.2 billion, and the Q3 it generated 22.6 billion. And so its free cash flow margin was significantly lower in Q4, and they blamed a lot of this on CapEx expenditure. Free cash flow was actually down 65% year over year, and for the full year they released $69.5 billion worth of free cash flow. Now, I do think this is a minor hiccup, but Google did come out and say they are planning to spend $50 billion on CapEx. The reason why their free cash flow was down 65% has to do with their capital expenditure, and I do think that Google is in a big CapEx cycle, and that is going to affect free cash flow for the next year. That being said, for the public portfolio, based on the research that I do think Google is undervalued, and we're going to go into valuation, and that's why I bought it for the public portfolio, and also because I use it every day. And I also use YouTube, which Google owns, and I think YouTube is a great business, a fantastic business, especially now that I'm a partner. I have like a lot of inside scoops into the YouTube partner program, and I think it's a very, very high quality business. That being said, I do see near-term volatility, and I do expect to add quite a lot to this position over the year. And this is like a long-term portfolio I'm building out. But if we assume that the free cash flow situation of Google then producing $8 billion was maybe just a once-off, based on figures we got here in 2023 of $307 billion in revenue, $69.5 billion in free cash flow, that's a 22.6% free cash flow margin. Using revenue figures of 2024, $342 billion in revenue and a 22% 40% free cash flow margin, you can forecast very, very conservatively $75 billion in free cash flow for 2024. And that would mean Google gets back to regularly scheduled programming, all-time highs, and that would put Alphabet's market cap at approximately $2.13 billion, and that's about 21% higher than what the current price is right now. Now, Bill Ackman is in Google. Pershing Square own a huge investment in Google. He said a bunch of things in his annual investor shareholder letter, and I'm just going to read some of the comments he made about Google. Google are a dominant player in secularly fast-growing global digital advertising market. Digital advertising is well poised to continue taking share from traditional media. Search and YouTube are two of the highest returns and most resilient digital ad formats. Revenue growth in Alphabet's core advertising business accelerated from 3% in Q1 to 10% in Q4 as the advertising market recovered. Bill Ackman also sees substantial margin expansion opportunity and capital return program. EBIT margins expanded 225 basis points in 2023 as cloud profits reached break-even levels. Cost control and operating leverage in under-earning segments, cloud YouTube, should sustain margin expansion while Alphabet invests behind AI initiatives, currently repurchasing 4% of its shares on an annualized basis. Now, structural benefits of decade-long AI investment and leadership. AI is deeply embedded in and will continue to enhance applications including search and 14 other products with over 500 million users each. AI integration in advertisers' tools will lead to greater conversion and monetization. And essentially right here, Google's a market leader. They have 92% share in search. They are an AI leader. Part of the reason why we're seeing the sell-off has to do with a lot of the bad press that AI has received, but I think the market is eventually going to look past that and Google will do really, really well in AI. I think they're going to be a leader in AI and they have so much cash in their balance sheet to invest in capital expenditure. And sure, that will have short-term effects on free cash flow, but at the end of the day, that's really going to benefit Google in the long term. And as an investor, you do want to see a company invest in R&D and reinvest in itself. Now, let's actually have a look at Google valuation. Now, this is a discounted cash flow analysis I did for Google. So you could see that all of its free cash flow metrics I put right here. Google on average has a growth rate of 27.5% over the last 5 years. Their most recent free cash flow figure is $69 billion, nearly $70 billion. That is absolutely crazy for free cash flow. The inputs are a 14% growth rate, a 9% discount rate, 2% terminal rate, very, very reasonable. Now you can actually put the discount rate very close to 7.8. Their actual weighted cost of capital is about 7.7. We're going to use a 9, have a built-in margin of safety. Now I also do think that the growth rate can be increased because Google are going to grow their top line at about 9%, and based on margin expansion as well as the amount of shares they're buying back, they're expected to grow their earnings per share at about 17%. So I've gone between 10 and 17. We've looked at 14, and I think 14 is a pretty good free cash flow growth rate, but we're going to adjust these as well. This is the amount of cash they have in the balance sheet, the amount of debt, a very healthy balance sheet. This is the shares outstanding. They are also buying back 4% of the shares. Don't forget that. And when you compute all of this, you get a fair value of 185. Google currently trades at 141, and they're 24% under fair value. And generally speaking, you want to buy stocks about 20% under fair value. And a company as high quality as Google, buying at fair value is not a bad idea as well. Now let's change some of these inputs to see what we get. Something I like doing on a discounted cash flow analysis is actually changing the growth rate until we get the fair value at the current price, just to see what Google is currently priced on a growth basis. Now I've already done this and it's about 7%. So if Google was to grow at 7% every single year for the next 5 years, take into consideration that they're buying back 4% of their shares, right? If Google was to grow at 7% for the next 5 years, they would be fairly valued, pretty much fairly valued at $140 per share. If they're to grow at 10%, which is the S&P 500 average, they're currently 11% under fair value, and they are going to grow at 14%. As you can see. Now we can also use a discount rate of 8 if you really want to. 9 is a bit high, but I like to build in that margin of safety. And you can see that if we are to use a discount rate of 8, 14% growth rate, we get a fair value right here of $209 for Google. And so you're looking at, this is the best case scenario, $209. And then you look at something like the base case scenario, $185. So you could sort of say meet in the middle, call it 190, and maybe Google's anywhere from 25 to 30% undervalued or under fair value. By buying Google, you're essentially getting an undervalued market leader set to grow in the mid-teens for the next 5 years. It's somewhat of a monopoly. It has a very healthy balance sheet and the operating leverage to literally do whatever they want with the amount of cash they have on their balance sheet. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.